Welcome, everybody, live from Palm Beach, Florida, and from Austin, Texas. It's Wednesday morning. Adam, welcome. How you doing?
I am doing really well today. Thank you. How are you?
Doing well, doing well. Glad to see everybody. We've already got some questions and comments. So thanks for joining us even before we started. We love it. We love it. So I got to tell you all a story. And this is a reflection of what is going on in the marketplace. And you may know about this. We've reported on it for many, many months now. The cost of lumber, the cost of all these packaged commodities. In fact, let me change the screen for a moment. The cost of all these packaged commodities that are the ingredients of a house or an apartment building, these construction materials, they are increasing at a rapid pace, especially lumber. It has been in the news a lot, saying that lumber cost increases are now adding about $24,000 to the price of a typical new home. So this increase is quite exorbitant. And this morning, when I was half awake, I was walking the dog, doing the early morning dog walk, and I saw a guy delivering some lumber to a house that's under construction in my area. And he had a truck full of lumber. I stopped and talked to him, and I said, "How much is that cargo worth?" I thought, maybe he should have armed guards.
Yeah, I was gonna say, did he have security guards with him?
Yeah, maybe he should have security guards with him because that is valuable. UPS trucks have been robbed. FedEx trucks have been robbed. Now it might be a lumber delivery truck.
Yeah. It's like how much is that truck of lumber? Oh, if you have to ask, you can't afford it.
Yeah, no, that's funny. I love it. And Adam, you probably saw this. One of our investment counselors, Sarah, she posted in one of our chat groups internally a really cool picture. By the way, I'll find that and maybe I'll show it later. It's just an amazing picture that's going to sum up the concept of lumber prices. But anyway, the guy said that this truck was about $15,000. He said that one sheet of that plywood was $43. Now, this is the delivery guy. I don't know if I can take that as the gospel. Maybe he does or doesn't know, but he seemed to be pretty confident with his answer.
A sheet of plywood's about $40. I priced one out the other day because I'm going to build something. A sheet of plywood's about $40.
Well, could you even buy a sheet of plywood?
I'm assuming Home Depot has them still.
Yeah, maybe not. Maybe they're not even available. Who knows? But anyway, so he said that truck full of lumber today is about $15,000. I said, "How much was your truck with the same load on it a year ago?" He said $5,000. So it basically triple in cost. But here's what I want you, couple comments on this. Number one, many builders are all around the country, all around the world, I'm sure too, but I've only heard about it in the US, have escalation clauses in their contract saying that they are allowed to increase the price of the home if it's a new home under construction based on the construction materials cost. And they'll usually tie it to some sort of index or something. But even if they don't, this data is widely available. You can just look it up online. And they are using those escalation clauses to increase the prices because they simply cannot deliver the homes at the price originally agreed to. There's no way they can deliver it. And we saw this happen before. For example, during the great run-up in the early 2000s, we saw many builders simply stop construction and say, "Look, sorry, I know I agreed to sell you the house at $200,000, but my cost has gone up so much, I can't deliver it anymore." So they would literally just leave the job. They would quit. And they would leave people with a half-finished home. But now the builders have become a little bit smarter, and they put these escalation clauses in their contract, and they are escalating prices, and they have the right to do it. Now, not all of them put those in their contract, and not all of them have the right to do it, but here's the rub. if they don't have the right to do it, they may well quit and leave you with a fat half-finished home. Now, that's likely a breach of the contract, and you can sue them and so on and so forth. But that usually isn't a cost-effective solution. Litigation.
That'll cost more than the escalation price.
Yeah, litigation doesn't really work very well in this country because it's so dysfunctional. It's so expensive. So this is all very interesting. Now, what else did I want to tell you about that? So here's the other thing I want you to keep in mind. The reason we have these escalations in these construction materials costs, or not the reason, but how to think about it. Let's make sure we're thinking about this properly. As I have said for the last 17 years or so, is that I want you to invest in things, and I want you to own and control things that are not tied to any one currency. They should be tied to something that has intrinsic value. Currency does not have intrinsic value. The dollar does not have intrinsic value. And certainly these things, these Zimbabwe dollars, do not have intrinsic value, right? Because they are just paper. They are not something that people universally need. They are something that has value due to fiat. And fiat, simply the definition, means by decree or by authority of a governmental body, right? And so this is fiat money, and so is the US dollar, and so is every other currency on earth. But money, something that is real money, is something that really does have universal need. And guess what has intrinsic value, universal need? It is what you're looking at behind me. It is these walls, this roof over my head. All of this stuff has intrinsic value because every human on earth needs food, clothing, and shelter. And I say, let them rent that shelter from you, and that will make you very, very wealthy. So let's all understand that we're only grousing and complaining about the construction cost increases because we are using one measuring stick, and that measuring stick is the US dollar. What if we measured the price of these construction materials in gold or Bitcoin or silver or Ethereum or some other measuring stick, right? What if we measured them in oil or labor cost indexes or the CPI in general, right? We're only measuring it in dollars. So we think the price has increased so much, but measured in other things, it's not the same, right? So let's make sure our head is on straight, right? And we are understanding that the dollar is only one measuring stick of relative value. What if we measured the price of lumber based on the price of copper, for example? I don't have a chart to share with you on this, but I'm just asking the question, right? If you look up a graph, a chart of the price of copper over the last year and compare it with the price of lumber over the last year, right? If you were dealing in copper as your currency, that would look very different than dealing in dollars as your currency. So just understand it's all about the measuring stick. And the dollar is only one measuring stick. Adam, any thoughts on that? And I'm sure, by the way, we'll get a lot of comments on that stuff because it's an idea that few people really consider. Sophisticated people that get it, they consider this. They understand this. If you were, a currency trader, an international currency trader, you would think this way, right? And this is the way everybody should always be thinking. It's always something to consider. What measuring stick are you using? Adam, thoughts?
I would agree. I mean, it really does depend. And especially whenever, it'd be one thing if it was going up only because lumber was going up, but there are so many other conditions in the market that are lending it there. Like you said, copper has gone up. Pretty much every commodity that homes are made out of has gone up due to, just a lack of them. On the podcast today, you're talking with a guy that's going to come out a little bit later. A guy's talking about it. There's just commodities. There's not enough. So when there's not enough, the price is going to go up. And so that's the situation we find ourselves in. And thankfully, when it comes to rental properties, when the price goes up, rents go up too. So
Right. Absolutely. But I will say rents tend to lag prices.
yeah.
So it takes a little while to kind of work that through the system because those rents only adjust typically on an annual basis when people renew leases. But
Yep.
prices, especially now, are just escalating so quickly. It's absolutely crazy how much they're escalating. Oh, we got a mad face instead of a like. Hey, it's not our fault, okay? So
We're just talking about how to play the game.
yeah. Hey, we're simply, don't kill the messenger. We're simply reporting on this, but we want to help everybody watching and listening from around the world. Which, by the way, please comment below and tell us where you're watching or listening from. This is syndicated on many platforms. So, of course, we've got our audience on YouTube. We've got our audience on several different Facebook pages and at different places. So you don't necessarily see all the comments, but we see them all, and we'll bring them together, time permitting, and put them all on the screen. So tell us where you're located. We always love to have a sense of geography, and really appreciate that. And just understand, make sure you view things in multiple measuring sticks. And by the way, of course, we have a free book at pandemicinvesting.com. Go get your free mini book there. No strings attached, no shipping costs, nothing like that. It's just a digital download, pandemicinvesting.com, that'll tell you how to invest during a pandemic. But also, another site I want to recommend for this measuring stick concept is pricedingold.com. Pricedingold.com. Really interesting website. I want to get the founder of that site on my show. I have not done that yet. Get him on the podcast. But he's obviously a gold bug and started that site a long time ago because it looks pretty old. But it's interesting because he does these comparisons of these different measuring sticks. So that's a really good resource to get you thinking about the concept of which measuring stick are you using, right? What if you priced construction materials in the cost of corn or wheat or pork bellies or soybeans, right? I don't know what the answer would be. I'm just saying you need to look at other measuring sticks besides the one that you commonly think of, which if you're in the US, you think of as the dollar, or even around the world, because that's the reserve currency of the world. So let's dive right in. Adam, do you want to dive into your presentation today and tell us what we're talking about?
Yeah, so we're going to talk about interest rates, market conditions, some of which is the lumber, and new forbearance news. So first off, as always, welcome. If you have any questions, comments, or need anything, reach out to us from jasonhartman.com, or if you're in the US, we have a toll-free number, 1-800-HARTMAN. Go ahead and give us a call. We're happy to talk. Doesn't cost anything to talk to us. So give us a call if you want. So we're going to start off today with interest rates. You see here, this is a 1-month chart that I pulled from MarketWatch, I believe. It shows the US 10-year note, which is most commonly tied to 30-year fixed rates. You can see it's gone up a bit in the past month. Now, I sent this out to my people and said, you know what, interest rates are going up, and I'm kicking myself personally because I could have locked in a 3.75 rate at 20% down about 3 weeks ago, and I can't do that anymore. So it's cost me some cash flow. But then I started thinking, there's always good news and bad news to things, right, Jason?
You started thinking compared to what?
Yeah. Well, right. not just compared to what, but I started thinking, okay, my interest rate's gone up. What could possibly be good about that? Yes, I'm losing cash flow, but what could possibly be good? And so I started thinking, all right, let's look at it as a whole. If I look at it as a whole, let's say I have a $200,000 home. I'm putting 25% down because all of our pro formas are based on 25% down. Who knows, with the way things are going, you may not be able to get a home for 20% down in the near future, investment wise.
Right.
But if we did
what
it,
Adam means to say is that the money for investors is tightening up. Now, this is good and bad, right? On the bad side, if you're building your portfolio right now and you're buying investment property right now, Fannie Mae recently came out with new guidelines, and just the general vibe of the market, if you will, is that they are making it more challenging for investors. But on the good side, the long-term picture, that means there will be fewer investors enticed into the market, which means less competition for the pool of tenants out there. So there's always an equalizing factor. And look, I've been doing this a long, long time. And what you realize is that the market does always equalize. Remember, when you were taking maybe biology class in school, and you heard that term homeostasis, right? This equalization, right? This balancing that your body does. Homeostasis, and you find that all throughout nature. And that happens in markets too. The problem is it takes time for that equalization to occur. And that's what kills people. They don't plan properly. They don't buy property properly. They don't structure things properly, and they don't adjust their thinking properly. And they don't have proper reserves. So when they go through that time of adjustment, they get thrown out. They lose money. They get discouraged. They let their emotions take over. And this is what ruins it for so many investors, is that adjustment period. Typically, in kind of any market, that adjustment period is 1 to 2 years. So that's the time where this discouragement comes in, this fear comes in, and people want to give up. And many of them do. But what separates the winners from the losers are the people who are willing to stick with things and understand that it's a time where homeostasis is being found, and the market is trying to find its balance and its equilibrium. And this weeds a lot of people out of the market. The other thing I want to say that Adam is addressing is that we talked about measuring sticks a few minutes ago. Understand that one measuring stick is another commodity that Adam is talking about right now. What is that commodity? It's money. Money itself is a commodity, right? Or currency. And the cost of borrowing that money expressed in an interest rate is the cost of the bet on the future, right? So the time value of money question, is that money worth more to the lender today, or is it worth more to the borrower today? And what should be the cost projecting that into the future in terms of an interest rate? And in the United States, thanks to Fannie Mae and Freddie Mac and the government in general and these pseudo-governmental entities, you have got a dysfunctional market in a good way. It's beneficial to us as investors because money, in terms of a mortgage, has been subsidized by these entities, these pseudo-governmental entities, since we came out of the Great Depression around the World War II time, all right? And so the money has always been artificially cheap. And that's how you can get your government welfare program as a real estate investor in U.S. real estate. So it's a great thing. Take advantage of it. Absolutely.
Yeah. So in this example, we're going to ignore the total monthly payment they have down there because that's just them estimating in general property taxes, and they have an HOA fee included in there. But we're looking mostly at the monthly principal and interest payment here. So $632.41 for a 3% rate, which you could have gotten 1 to 2 months ago. Nowadays, we're looking closer to 3.5%. So at 3.5%, you're paying $673 a month for your payment. So that's a difference of $41. So your cash flow has been hit. So that's the downside. Your cash flow has dropped $41. What's the good side? The good side is real estate is not a one-dimensional asset class. Real estate is a multi-dimensional asset class. When your interest rate goes up, guess what you pay more of? You pay more interest. So looking at this amortization schedule, this is in 1 year.
And that means you get more tax deduction.
Exactly.
So we should remember, depending on your tax bracket, the government is your partner. And you might be paying $41 extra, but say your combined state and federal tax bracket, I hope it's not, this would mean you live in like the Socialist Republic of California or the Socialist Republic of New York, it could easily be 50%. So about half of that, or close to half of it, is paid by the government. So you're really only paying, about $21 or so, right? Go ahead.
So this is at the 3% mark. You're paying the first year, you're going to pay $4,457 that year in interest. At 3.5%, you're paying $5,204 for the first year. So your cash flow difference is just under $500. Your mortgage interest difference is $750. That will offset your cash flow from this property and others. And a lot of times you can carry, if it brings you into a negative cash flow for the year with this mortgage interest write-off, you can carry those losses forward. So you're actually, yes, you're making less in actual money in your pocket, but the flip side is you're getting to write more off on your taxes from your mortgage interest.
And so, Adam, I do want to reiterate the disclaimer we made.
We're not tax professors.
Yeah, that we are not tax advisors. We are not legal advisors. So, check with your CPA, your accountant on this kind of stuff, because it does get pretty murky and complicated. Right. But, we're just giving you ideas for discussion points.
Yeah. So in general, this is true for the most part. So, we can't tell you exactly what your taxes will do, but you are taking a hit on cash flow, but they're gifting you more in interest, and the properties, you still have to make sure the properties you're buying make sense the day you're buying them. But even with a higher interest rate, there are trade-offs that are helping you in today's environment of rising interest rates. Right. So this is one of the things that you need to look at whenever you're starting to see a property and you think, oh man, I don't know, 3.5% rate, which is still incredibly low. That's, with the rising prices, my return's getting squeezed. Yes, it is for at least the first year, but you're getting helped in other ways. And then I wanted to say, you know what, compared to historical averages, oh, I guess I didn't put that one in there. Compared to historical averages, oh, where is it? Oh, I put it in there. Oh, there we go. I put this in the wrong place. Historically, you look at interest rates. These are some of the homes that I've purchased and their interest rates. 20% down, 5.25%. 20% down, 4 7/8. 20% down, 5 3/8. At 25% down, I could only get 6.125. At 25% down, then I could get 4.75. 20% down, I could get 4.5%. So historically, in today's rate, $150,000 purchase price, which all of these were around $100,000. Now you can get 4.125 with 20% down and 3.625 with 20% down or lower. So, it's historically speaking, interest rates are not high. The only reason they're really impacting us right now is prices are going up, as we've discussed.
And if you follow my Creating Wealth podcast and other YouTube videos, and by the way, our videos are on many platforms. So if you want to hear our more controversial stuff that would be censored on the main platforms, which is absolutely pathetic that they are censoring us, but it is what it is. Then you can find us on the other platforms like Odyssey and BitChute and Rumble and all of those. Okay, but yeah. So if you follow some of our other content, you'll know that I have done presentations and episodes all about how, adjusted for inflation and interest rates and current prices, which so many of the uninformed people think are so high, but they're so wrong because they don't adjust for interest rate and inflation. They only think about the price of the home. And they say really dumb things on television. And they say, well, prices are higher than they were at the prior peak. And right after that last peak, 15, 16 years ago, there was a great recession, 13 years ago, or I mean, it kind of depends how you count it. So don't quote me on the years. It depends when you think the peak was and when you think the start of the recession was, and so on and so forth. But you get the idea. And it shouldn't be judged by price only, because most people don't buy based on the price of the home. They buy based on the monthly payment.
Yeah. Do you want to take some of the questions over on the side here before we
Sure,
move to our next bit?
So do you want to start at the top, Adam?
Yeah. So Nemo Deals hopped on before we even started and said, I have 11 rentals, 6 of which are in Washington State. Because of their moratorium, 5 of them have lapsed into month-to-month tenancy due to restriction on rent raises. The 6th rental is not far behind. You want to scroll to the next one. He continues, in effect, I am losing money due to expenses, maintenance, tax, and insurance increasing, but rental income is stagnant. Thumbs down, Washington State. My other rentals in Oklahoma and Florida, thumbs up. This is a perfect example of why you have to buy in markets that are kind to landlords.
Yes, we always say that, thou part of my 10 commandments is thou shalt be area agnostic. And we want to always be buying in landlord friendly markets. Washington State, the socialist republics of Oregon and California and New York and many others are tenant friendly. If we're going to do business somewhere, we want a climate that is friendly to our cause as investors, as landlords. So, yeah, good stuff.
Yeah.
And then,
so what we're experiencing is we haven't really heard any complaints from our investors that we've worked with in regards to having issues with payments or evictions. Yeah. I mean, that's just not something that we're experiencing. It's been surprising. We've talked about it as a group. It's been very surprising. We were worried about it, but a lot of our markets are still, you need to evict somebody, you can evict them, assuming there's no, COVID hardship that they're experiencing that they can claim, then you're pretty set.
Absolutely. Yep. No, it's looking pretty good. Okay, Adam.
So rated said I got 2 duplexes last year for 2.75. I'm assuming that's his interest rate, which fantastic. Just signed contract for another today. Congratulations. And the rate is 3 3/8 now. Only 3 months later. I only invest in Texas. The same duplex went from 225 to 245 now. Yeah, Texas is a booming market. But yeah, the interest rate jumped up. But you know what? In 5-10 years, that 3 3/8, you're going to be very happy that you're, at that rate.
It's going to look super cheap. And, I have owned many properties in Texas. I still have a couple there. But as I've said for about 2 years now, Florida is the new Texas. The action has kind of moved. Texas is still, good, but not as good as it used to be because the prices have inflated quite a bit. The property taxes are very high there. And, it's become a little bit expensive. So this is always kind of a moving target. I would really encourage you to look at some of our other markets, not just Florida, but, North Carolina, Tennessee, Arkansas. We've got very good properties in many markets around the country. So good stuff.
Yeah. So Nunya Business said, first time home buyer, what I'm experiencing is over leveraging. This is a sign of a near top. How long until people like yourself cut bait and pull equity? Now, this is a very good example here, I believe, of what market you're in and what price points you're buying. I will say I am concerned about the high-end markets, as we move forward, as price appreciates, and, especially the coasts, those cyclical markets right now, they could be in for trouble, but the homes that we're looking at, the under $300,000 homes, they're not building them much. There's not enough of them, and there's a high demand for them. So people who are buying these ones, the ones that are $250,000, they are not over leveraging themselves. The people buying the $1 million, $2 million1,000,000 that are 1,500 square feet, they may be over leveraging themselves, but they're not in the markets that we're looking at that we recommend. You really have to segment out where the real estate crashes could happen.
Yep. That's very good. The linear markets are the markets we really like. And if you want to know more about linear, cyclical, and hybrid markets, be sure to check out our podcast, The Creating Wealth Show, and you'll learn a lot more about that.
Nemo Deals said, I would have agreed with this, except certain states I no longer control my real estate. Yeah, this is the one, Washington State, where you have your properties. Yeah, they're kind of yours. You co-own them with your tenant in a lot of ways.
You co-own them with the government.
You've got two partners. You got the government and your tenant. Your tenant kind of gets to decide when they move out, and the government tells you, yeah, you can't touch them.
And we don't like that at all, because we want landlord-friendly markets. Adam says hello. The other Adam watching. Hello, Adam. And R-Rated is in Austin, Texas. Your neighbor, Adam.
Yeah, awesome. Ooh, man, Austin, Texas is blowing up.
Yeah.
Roadrunners in London. Adam Capitano is from Adelaide, Australia.
Oh, beautiful. Love it.
Got, I'm going to guess, Ramit from Edinburgh, Scotland.
Edinburgh.
Oh, Edinburgh, sorry. Yep. Peter is from Colorado, Rocky Mountains. Welcome.
Excellent. John Denver, Rocky Mountain High. Love it. Yeah. I'm a big fan.
Yeah, so Mike from Oregon. Man, we got some, we're all over the place.
We are.
Nemo is in Oklahoma.
Awesome. Looks like I'm the only one in the chat room. No, you're not.
Nemo, you're looking in the wrong chat.
You see, that's the thing. Depending on which platform you're seeing this on, you might only see a few comments, but we see them all because they're aggregated from all the different platforms. So
yes, we got Peter in Chicago and Ferris in Ontario, Canada. Man, we're international this morning.
We are. I love it. You international people. Great to see all of you.
Yeah, and Nemo said, my physical self is located in Oklahoma. My investments are in Washington, Florida, and Oklahoma. Yeah, Oklahoma and Florida, solid choices.
Yeah,
we have inventory in Florida. We are getting more inventory in Oklahoma again. So, those are, if you're interested in getting more in those markets, reach out to us. We're happy to help. The H Underworld from California. So there would not be a housing crash or pure speculation, or doesn't affect specific geographical areas. California, I'd worry about a housing crash.
Oh, definitely. Very much so. California does not have a good looking future right now. California and New York are really making a lot of mistakes, sadly. But that's my home state, but I'm glad I left it 10 years ago. It was one of the best decisions of my life, leaving California and leaving those high taxes. Yes. And from Atlanta, good stuff.
Hey. All right. Raj says, great stuff. 900 doors in Texas and growing with the 10-year. You're doing all right.
That one, Raj, we have to give you a hand. 900 doors. Wow. Fantastic. That is awesome. Awesome.
Yeah. With the 10-year going up, will this impact cap rates in multifamily and hot markets like Dallas?
Yeah, I think, we're seeing cap rate compression pretty much everywhere. and that's because the cap rate is a function of the income the property produces versus the price of the property, right? And so when prices escalate, they escalate faster than rents. So rents always lag the prices, at least historically. And so cap rate compression, definitely a thing. And Ian is in Melbourne, Florida. Good stuff. Not too far from me here in Palm Beach.
Yeah, and Raj likes your homeostasis analogy.
There you go. You're a doctor. Okay, good. Did I get it right, Raj?
Close enough. Close enough for government work.
Close enough for government work. Good stuff. Lost my place here. Adam, you want to move on for a few minutes, and then we'll get back to some more comments and questions. Keep them coming, folks. We love them.
Yeah. So now let's talk about market conditions. So I'm going to touch on what you touched on before, and that's lumber prices. As we've discussed many times, but I learned something new about why lumber prices are high, and that's why I wanted to share is you can see the skyrocketing lumber costs going on. The dip was, I'm assuming it looks like it's right around the time that the lockdown started, but then even the dip was to the previous high, and now it's back up over $1,000. Yeah. So the U.S. wood shortage, this is what I learned recently, can be traced to a decades-old beetle infestation in Canada. You can see all of that along the way here all of this kind of pinkish stuff. Well, the shortfall in supply is part of an older saga involving the mountain pine beetle. It's been in the Canadian forests for decades, but it's been kept in check by cold winters. And due to rising temperatures in the area, the beetles haven't been killed off as well. And so they're eating at these at the pine, and they've attacked more than 44 million acres of forest. So an area 4 times the size of Switzerland. And they said you can go up in an airplane above British Columbia and see the damage. The dead pines have a red tinge to them. So you could fly an hour and just see this red kill. So all of that red stuff you see is lumber that is just dead that could have been harvested before. And so what they did at first is they just said, you know what, this is starting to kill these trees. Just go in and harvest them. And so they just went crazy harvesting this wood. And now they don't have any more to harvest because it's all died off. And so we're seeing a shortage in supply. Then you factor in the COVID pullback, and then you factor in the 20% tariff that we recently had on Canadian lumber. They dropped it down to 9% recently, but there's still a decent tariff on the lumber coming in. And all of these are conditions that lead to higher prices. So this man is Kevin Mason, the managing director of ERA Forest Products Research, said, I think prices will be volatile, but they'll continue to be high and for the next 3 to 4 or 5 years. You can't start up new sawmills overnight. And if you go to the equipment makers, there's a waiting list for some pieces of equipment of 2 to 3 years. So some people have said, why don't they just start up more mills and mill in other places? Well, 3 years out from starting your new mill. So these are some of the things that are happening that the lumber shortage can't just be solved overnight by opening up new mills and getting people back to work from COVID. It's just a market condition that's there that we're going to have to deal with.
Yeah, right. Very, very good points. Very good points. It's not easy to deal with. And you also have a lot of regulations that you have to deal with. They won't just let them open up a mill and start cutting down trees. This is something that environmentalists will rally against, and there'll be all sorts of issues. By the way, one of the solutions that there are many entrepreneurs out there who are trying to solve these problems, which is one of the great things about capitalism, is that it really incentivizes people to try and solve these problems that society incurs. And we've all heard a lot about the manufactured housing, 3D printing. I'm interviewing really, I think, one of the big thought leaders on 3D printing today, and that'll be on the podcast and on the YouTube channel with a lot of visual aids. And we hired him as a consultant. We had a consulting meeting with him yesterday, Ashley and I did, and it was really enlightening. But these are not the panaceas people think they might be. You go surf around, watch a couple videos, and you think, oh, they're just going to 3D print all the houses, and this will all be just solved. Or there's these kit homes I can buy on Amazon for $30,000 to $50,000, and I'll just have a house. No, there's much more to it than that. Folks, we have done a ton of research on this for a couple of years now. And I've been following the 3D printed home revolution that I hope comes, but it's not here yet, for probably 10 years. And it's just not quite here yet. I met with, online, met with a company last week to talk to them about buying a 3D home printing rig. I was going to start a construction company, buy it myself. I might still do that. But there's just a lot more to this than meets the eye. These are not problems that will be solved quickly. It's just a long. These supply shortages are going to be with us for a while, folks.
Yep. So Robert Dietz is the chief economist for the National Association of Home Builders, and he had a tweet a couple weeks ago. Said solid new home sales for January, with sales up more than 19% year over year. at a $923,000 annual pace. Inventory remains low at 4 months supply. Prices up on a median basis by 5%. Affordability concerns loom in terms of building material costs and higher interest rates. The interesting thing he said next was there is a rising count of new homes offered for sale that have not started construction. Total of 81,000 now. That's a 45% gain from a year ago. Wow. So this is just leading to, inventory shortage after inventory shortage, to the point where our investors have been buying homes, before they're permitted for, a while now. But you see it's just gaining in popularity because they just can't keep up with the demand and they're not sure about pricing. So, right. Yeah. And that is, in 2020, we saw about 1.45 million permits for new construction. 81,000 is 5.5% of the total permits for the year. So about 1 in 20 homes sold in this coming year are likely to be, offered and sold, but not even started in construction. So that was just an incredible number I saw, and it shows just how much demand is out there.
Yeah, it really does. It's absolutely staggering. I got into the real estate business when I was 19 years old in my first year of college. And I have to say, I've been through a lot of cycles by now, and I have seen some absolutely crazy markets where properties sell before coming on the market with multiple offers. Literally, it's a foot race to try and buy the property. People camping out at new home construction sites. I've just seen crazy stuff. I remember in Newport Beach once years ago, I was in line to buy a new home in this one area, and there was literally a riot of rich yuppies with Starbucks cups in their hand. They rushed this. I was there. I saw this myself. This was before the time when everybody had a smartphone and a video camera with them. I wish I had a video of this because I remember it now. And I've seen crazy stuff, but I don't know that I've ever seen the market this crazy. And this time around, yes, there is definitely some frothiness. I'll be the first to agree with that. But there's a lot of fundamentals supporting this time around, where I just don't see the oversupply problem for a long time. And we have a situation, and maybe you've heard my prediction if you listen to the podcast or watch the other YouTube videos on the channel, that people are going to cling to these ultra cheap, artificially cheap mortgages. They're not going to let these properties go 3 years, 5 years, 7, 10 years from now. There's going to be a huge incentive to keep these unduplicatable, irreplaceable mortgages. And that's going to further constrain housing supply into the future.
Yeah, that's one thing I actually thought about whenever my interest rate for the properties that we're going to be closing on soon happened, is I thought, if I close at, even at 5%, if it goes up that high, which I don't expect it to, but who knows? Even if I get it at 5%, I'm actually mentally more likely to refinance that loan and do a cash out refi. It'll be easier for me to do than if I got it at that 3.75. It's just, the mental hurdle that you're going to have to get over to do a refi and, increase your interest rate, even if it makes sense, is a lot easier whenever it's at 5% rather than 3.5%.
Yeah, it sure is. And remember, you can't move the mortgage with the property. The mortgage is attached to that property. So people are not going to let these properties go. They're likely to improve them. So, if there's maybe listen, I'm not a stock market guy much. I think Wall Street is the modern version of organized crime, as I always say. But, maybe there's a little stock tip in here. Buy Home Depot and Lowe's and home improvement companies. Not now, because they're already run up quite a bit, but in the future, you're going to see people doing home improvement projects. You're seeing it now, certainly, but in the future, you're going to see them do it because they don't want to move. They don't want to give up those cheap mortgages that they have. And so they're going to be incentivized to stay in the property.
Yeah. All right. So let's see.
And I've got a couple slides to share when you're finished with your slides, Adam.
So as I've said before, and I'll continue to say, when conditions change, strategies must change. But right now, conditions have not fundamentally changed. Interest rates have gone up, but they haven't gone up to the point where they have fundamentally changed the market that we're looking at. Now, I want to reiterate, I am not talking about, $500,000 homes, $1 million homes. I am talking about the investment properties that we're looking at. The under $300,000 properties, the fundamentals for that market are the same as they were when the interest rates were 3%. It's all pointed up. So when will the crash come? How bad will it be? The fundamentals just aren't there for these markets to plummet, to drop. And so if they're not there, if the fundamentals haven't changed, your strategy should not change. So,
yep, absolutely. Good point.
There's the interest rates that I messed up the slide place. And then we're going to get the forbearance. So if you want to take over before we get the forbearance.
Okay, sure. Let me go ahead and share my screen here. Just a moment, folks. Adam, if you want to grab another question while I do this.
Yeah, so
I don't know that we've done a double screen share before where yours is sharing and mine is. So just give me a minute.
All right, so let's see. I'm pulling through. Just scrolling down here.
Here you go, folks.
Oh. I remember that one.
Isn't this great? Sarah shared this in our internal thread, and take me to a romantic dinner, to an expensive restaurant. Oh, it's the lumberyard. I mean, that's the new place to wine and dine your girl, guys. Okay, take her someplace expensive. There you go. Good stuff. And a couple other things I just want to share with you. Of course, if you want to know more about my trademark packaged commodities investing strategy, which is about the ingredients of the property, or my assembled commodities investing strategy, somewhat interchangeable, those terms, check out the podcast, the Creating Wealth podcast, or visit jasonhartman.com. Check out some of the other videos here on the channel. Also, my trademark refi till you die strategy, spelled several different ways depending on how you want to do it. It's just a great strategy that can help you extract wealth from your real estate portfolio efficiently in the most tax efficient manner as well. Really just a phenomenal strategy. And then, of course, one of the big ones that people have loved for so long, and that's my inflation-induced debt destruction strategy as well. We've talked about that on some of the live streams, but if you've missed those, be sure to check out the podcast, The Creating Wealth Show, and the other videos here on YouTube. One of my YouTube videos recently, it's up over 300,000 views, where I talk about inflation-induced debt destruction. So be sure to check that out for more information. And Adam, back to you.
Okay, so now we want to talk about, or you want to take a couple of, we can talk forbearance, because that'll be...
Let's do a few things here. So we left off with Raj saying he liked the homeostasis strategy. He's a doctor, so he knows.
Yeah, we covered this with Rated as rates going up and as duplex prices going up.
And by the way, Adam, that's not rated, that's R-rated.
Oh.
Do you get it?
Yes. Very nice.
I like it. Pretty good.
This is why Nemo says, this is why I took out equity lines of credit against my Washington properties a couple years ago when lending was loose, doing the equity stripping that Hartman recommends into the Midwest rentals. Yeah, good. This was definitely 2020, late 2020 was definitely the time to be doing equity stripping from your properties, because a lot of times you get equity strip and lower your interest rate, 1.5%. So yeah. Good job.
Equity stripping is a very important strategy. So Nemo, I'm glad you followed our strategy there and benefited from it. That's great.
And so Nemo's equity line of credit was 4.24% variable interest rate, tax-free money, and I don't pay unless I borrow. Yep. So that's a good rate.
Good stuff. But I don't like variable interest rates, just so you know.
Right.
Because I do think the rates are historically low and you should lock them in as much as possible. But
doing that a couple years ago when she opened the line of credit, 4.24 was pretty solid, because it's probably set for a few years.
Right.
So
Okay, so hello. Is there a lot of echo or?
no, this was Nemo isn't in the right chat.
Oh, okay, all right, okay. Oh, okay, got it, okay.
Yeah.
Okay. Oh, they're just talking amongst.
Yep. Then there's a bunch of chats. So Juan down a little bit later said no single family homes in Miami under 250,000. Not even unsafe neighborhoods. Yeah, we're not touching Miami.
Yeah, doesn't surprise me at all. Miami has really never been one of our recommended markets, so too expensive. Yeah, but not too far from where I live. Okay, so do you want to get some?
I'm assuming, yeah, R-rated said one of the duplexes I bought was mandated by the government as an investment in a poverty area, and it said I would get some sort of tax credit because of this. Can you elaborate on this? I'm assuming that's an opportunity zone?
It might be an opportunity zone. I don't know. There are other things out there besides opportunity zones, but that may be what you're looking at. The opportunity zone thing, we have never been very impressed by that. We've done some shows on it, of course. There's going to be a lot of scams in the opportunity zone world, so be careful. It is somewhat complicated. It's really meant for developers who are doing somewhat significant building projects or renovation projects at the very least.
Yeah.
But check out my podcast for a lot on opportunity zones. I interviewed the architect for the opportunity zone legislation on the podcast. He worked for Obama in the White House and really architected that whole legislation. And that was a fascinating interview, even though I'm not too impressed with opportunity zone stuff, unless some new information or comes along where maybe I'll get impressed by it in the future, but I just haven't been impressed with the whole thing.
Yeah. So they do a lot of talking until about 10:36 your time.
Okay.
If you want to scroll down there.
All right.
So LG said lumber prices have gone up for a reason. The mortgage interest rates going up this quickly has me much more concerned. So I blame the mortgage increase on Jerome Powell opening his mouth and Fannie Mae just kind of throwing this 7% restriction on the market that nobody saw coming. However, what happened was Fannie Mae said, all of you lenders, you need to have your, investment loans can only be 7% of your portfolio, or else we're going to hit you with penalties. And this made rates jump because the lenders who were over 7% started saying we need to cut back on the number of investment loans we make, and we need to make more, primary resident loans. And so that did make the rates jump. Now, a lot of it, their banks at this point or lenders at this point have decided we're either going to take the hit or, we're going to get under. So I don't know how much more rate increase we're going to see because of the Fannie Mae thing. Jerome Powell just happened because he opened his mouth and said, yeah, we might see inflation earlier than we expected, but it's still 3 years down the road, 2 to 3 years down the road, and people just freaked out about it. But the rates have been coming down slowly recently, but I think we did see the big jump because of those two things, and now the market has kind of reached a little bit of an equilibrium until who knows what happens next.
Yeah, and I will say Jerome Powell is not worried about inflation. He's been very clear about how he doesn't care or is not worried in the least about inflation. He is.
Yeah, we're not going to see the Fed rate rise anytime soon, but his comments about inflation caused the investors to need more return in order to make the loans.
Right. Good stuff. I'm just trying to get through. We got a lot of comments today, so I'm trying to just sort of scroll through some of them. Adam, if you want me to stop somewhere, I will. I kind of lost my place.
Yeah.
So.
Oh no, this is a conversation they've had that goes on for a while. Okay. You got to get down. So Ian asked, how about alternatives to lumber, insulated concrete form construction with steel studs for interior walls? Part of the problem is all commodities are going up in price.
Oh, steel has risen dramatically. Adam, do you want to share anything from one of our North Carolina local market specialists?
They stopped doing steel.
Yeah, they were building steel frame homes because lumber got too expensive. Then they stopped building the steel frame homes and went back to lumber. But I think either way, it just doesn't work.
Yeah, it was. Yeah. Ben said, "What about 3D houses?" We covered that one.
We covered that. If I guess that's how you pronounce that. If you just joined, go back and watch this and just kind of watch from the beginning. And we covered the 3D printed housing quite a bit, and have definitely covered it on the podcast as well.
Yeah.
Okay, we got that one. Okay.
Trump tariffs are the issue. I mean, yeah.
Trump hater Adam, this is your new friend.
Well, no, I covered it. I mean, the tariffs did hurt. I mean, and they did drop it, I believe, to 9%. But even a 9% tariff is going to get passed along.
Yep. So. Okay, and we got a comment about the pine beetles that you talked about.
All right, okay. We just covered that one. And all right, so Eric says, I'm looking at houses in Cape Coral next week, plan to Airbnb and use as our vacation home. I figure a $400,000 home will be 18 to 20% return on investment at 3% appreciation. If Airbnb can just cover the bills, I assume cover the bills while you're not there. I mean, it's not a bad strategy. And I think 3% appreciation in Florida is going to be very low. Like Florida is going to do better than 3% for a while.
Yeah.
Based on current builds.
For a while, I think you're definitely going to be much better off than 3%. And, we dabble in the short-term rental market a bit, but not too much. We really like the long-term buy and hold rentals. Airbnb becomes your partner and they can really ruin your life. I've heard a lot of horror stories about Airbnb. Remember, it's this independent company. They can censor, they can cancel your reservations. They have way too much power. Of course, vacations are optional, right? So in an economy that is really, really under stress, remember, nobody is required to take a vacation. They do need a home to live in. So we like the necessity housing. Certainly you can make money with short-term rentals. Many people have, many of our clients have, in properties that they purchased through our network. But, just keep that in mind, balance out your portfolio. Don't go all in on that. Okay.
So Peter likes the look of the beetle kill lumber and likes the higher prices because he can actually buy what he needs. Last year lumber was unavailable. It's not all bad. Yeah. I mean, there's trade-offs for everything.
Every problem is an opportunity, one man's terrorist is another man's freedom fighter, as the saying goes, right? So that's true.
Yep. Nemo loves Oklahoma, adding the portfolio there. Yep.
It's good.
Good state to do it. R-Rated said the builder of my duplex said that a guy from California came and bought all 4 of the duplexes, all cash. Said that he had $1 million property in California and could only charge $2,100 month rent. Yeah. Wow. I mean, California, once $1 million properties rarely make sense investment-wise.
No, they don't. This is the rent to value ratio, the RV ratio discussion that I've been talking about for 20 years or so, and it's basically you're never going to get a good rent to value ratio on an expensive property, on an expensive single unit property. It's just never going to make sense. So you want to ideally rent a property like that for yourself to live in, right? That's the ultimate arbitrage. Rent the expensive property, live in it yourself, get a beneficial RV ratio for you. And then own a lot of inexpensive rental properties, affordable housing that you rent to other people, where that rent to value ratio is also beneficial to you. So you get the best of both worlds from either side of that equation.
Yeah. And we've talked about how the RV ratio isn't as important now, but a 0.2 RV ratio is never going to do you good.
Never going to work. Yeah. Yeah. And what Adam means by that, and I did a podcast episode on this, I actually did 2 of them. It's very important that you hear these so that you are not too constrained to the rent to value ratio thing, because it has been upended by the extremely low interest rates. Things.
So Maria says hardcore blue states suck for small landlords. Definitely can put a damper on your portfolio.
Yeah. We'll say yes to that one. Absolutely.
Too much wood used in houses construction in USA. You should think more affordable input materials.
And what are those, Juan?
Yeah.
There's, like I said a few minutes ago, there's a whole community of people trying to solve these problems with cheaper input materials, with new types of bricks made out of different materials. The 3D printing thing. All of it. The concrete is very expensive. So if you're 3D printing in concrete or doing it with some sort of brick material, I mean, all of these prices for every input material, they have increased dramatically. So please don't just say cheaper input materials. Tell us what they are, because the whole world is looking for these. There's a global housing crisis. I mean, entrepreneurs are trying to solve these problems. So do tell. Give us your suggestions for less expensive input materials.
Yeah. So R-rated said daughter's teacher said that house across the street from her went for $200,000 over asking during the winter storm last month. Sight unseen here in Austin. It's insane here. Keep going.
Yeah,
Next
and Adam,
one.
you live in Austin, so you could testify.
Being in Austin, especially Cedar Park, why have the rents not gone up much out here? My house bought in 2015 and live-in was a stew, but the rents barely have gone up here. I'm guessing steel. They sit around 1,800 to 2,200.
Maybe it's a mess. I don't know.
Yeah. So I don't know why Cedar Park rents haven't gone up. I can tell you where I am down in Southwest Austin, rents have gone up, 20% in the last year. I mean, home prices have gone up 30%, but I don't know why Cedar Park hasn't. My guess would be it's because Cedar Park's kind of far out there. But yeah, the Austin housing market is insane. We have 0.4 months of inventory in the market right now. Homes are going for 150,000 over asking price on a regular basis. Yeah. Like, it's just, Austin doesn't make sense right now.
It's absolutely incredible what's going on. Yeah. And by the way, I should mention, hundreds of investors purchased through me in Austin 15 years ago. They made a fortune, okay? An absolute fortune. And in Houston and Dallas and San Antonio and Charlotte and so many of our other markets. So folks, don't miss the opportunity. Go to jasonhartman.com if you're not connected with us, or go to pandemicinvesting.com, get your free book either way, and connect with our investment counseling team. It's free to talk with them. They'll be happy to help you and help you develop a strategy to build a secure, prudent, nationwide real estate portfolio that can just change your life. We've helped thousands of people do this over the years. And it's just, I mean, we have so many testimonials, people on video, on the podcast. You can hear their client case studies where you'll hear them talk about the portfolio they bought, the good, the bad, and the ugly, the problems, the benefits, everything. So we've been doing this for a long, long time and can help you do it too. So good.
Yeah.
Okay. Hi, Sarah.
Morning, Sarah.
One of our team members who can help you. Okay, and All-Nighter Hider is back. We haven't heard anything from you today, so welcome.
Yeah. All right.
This is just a good morning, right? Yeah. Okay. Well, good morning, and we appreciate having you on board. So thank
Nemo
you.
says, I have a saying about landlords and real estate investors. Anyone can be one, but are you still one 20 years later? Staying in the game is the name of the game.
Absolutely.
Yeah, so LG says new lockdowns in other countries. In the U.S., a lot of people who wear masks at work do not want to wear a mask on their leisure time, so they're staying home. Rates are going up too fast. Now, LG, a lot of states are just flat out opening up and saying, you don't have to wear a mask. Now, businesses can say you have to wear a mask if you come inside. But, a lot of places are just opening up. I know Texas is. I think Mississippi did. Florida pretty much is, right, Jason?
Oh, Florida. I'm telling you, we went to a concert the other night, Saturday night, and you would think nothing. There's no pandemic. I mean, it's absolutely amazing. COVID 1984, Florida is like pretty darn normal. Some people at the concert were wearing masks. They were packed in. People had no qualms about getting together, restaurants open. After the concert, we went out to dinner. I mean, it was great. Just everything. It's like life pretty normal.
Yep. All-Nighter Hider says, hit the like.
Hey, thank you, All-Nighter Hider. I appreciate that. Thank you. Everybody, I know there's a lot of you watching and listening right now. Smash the like button, folks. We need you to hit the like button, and we appreciate your nice comments. Be sure to hit the like button, subscribe, and be sure to hit the notification button so you'll be notified when we come on, because a lot of times we do these live streams very impromptu. You know, I just have something on my mind. I got to get it off my chest. I got to share it with you. It's just too good not to share. And that'll be one of those impromptu live streams where I'll just jump on and say, hey, here's what's happening. I just learned this. I just heard this. Here's an article. I got to talk to you about this. So make sure the notification bell is, you push the notification bell as well. So thank you very much, and appreciate it.
Yeah, so Nemo Deals says managing rental properties or managing the management company that manages your rental companies is a whole bottle of wax that goes beyond just converting your property to a rental.
Yes, that is true, and we help you do that. We help you manage your managers. We also teach you how to self-manage and provide a bunch of tools for that as well. I have self-managed many properties over the years, properties I have never seen, tenants I have never met, properties that were 2,000 miles away from where I live. And you know what? I'm amazed that you can do that, but you really can. And it's a great thing. So you don't have to be beholden to a property manager. So, you know,
I will say, Jason, I'm going to go see one of my properties for the first time ever in April.
Oh, yep. And where is that?
It's in Little Rock. But the only reason we're doing it is we're going to St. Louis for a vacation, and we're going to swing by Little Rock on the way home so we can ride off the trip.
Oh, fantastic. Good stuff. Yeah, you're going to go see one of your properties for the first time. I'm doing 1031 exchanges and selling some of my properties right now. And, you know, I've never seen the properties. Didn't see them when I bought them 15 years ago. Didn't see them when I sold them. Never saw them. Never met the tenants. You know, it's great. I mean, you really can do this remotely. So LG, businesses have not recovered yet. Well, some businesses are doing great. Some are struggling. We all know that. It's very uneven. Adam, any comment on that?
I agree. You know, Nemo says also not every property should be a rental property. Unfortunately, I think a lot of homeowners are going to find that out when they convert it over.
Yep.
Yeah,
absolutely.
I mean, but I will say the low interest rates that are going on now, if you can get a low enough payment, people might think they make sense, you know, in 10 years because they can make some form of cash flow on the property. The question is just, is it worth turning it into a rental and making $200 a month on your $700,000 house when you could, you know, convert that into 4 or 5 different rentals that can get you, you know, a couple $100 a month cash flow on those in a potentially better market, you know, and safer market for a landlord.
Yeah, absolutely. Okay, so fish fat. I love it. I love these names. Some of you come up with R-rated fish fat. Oh, that's great.
Arizona market is insane due to Cali folk outbidding locals.
Yep, that's true. I totally agree. And Sarah says true. Yes. and
Arizona, interest rates.
Expensive. Nothing works in Arizona that we have found, at least.
Yeah, Sarah says interest rates are where they were about a year ago, still better than pre-pandemic, and they were great then. Yeah, I mean, interest rates are still a little bit lower than they were, you know, back in January, February of last year. So, you know, we're still in a very good position.
Yeah. And I love this comment.
Roland says, waiting for the fat lady to sing. You might be waiting a while.
Yeah, I think you're going to be waiting a while. The fat lady is going to sing unevenly. She's going to sing in, and that means it's over, right? It's never over till the fat lady sings. That's the way if, you know, I'm sure everybody knows the reference. And, you know, all markets will end. Everything is a cycle. We do not deny that. We want to help you play it. We are not market timers. We buy prudent, cash flowing properties that make sense the day you buy them. And they will only make more sense into the future, okay, if you buy them right, in the right markets, with the right structure. So Roland, do not worry. You'll love it when you see the fat lady sing, because it's going to benefit you. It's not going to hurt you.
Yeah, so Craig says equity stripping has another meaning. If you hear someone say it is illegal, it is a predatory practice referred to as equity stripping.
Yeah, well, I think you're referring to lenders and predatory lenders who were basically giving people very bad predatory loans, telling them to pull out money, use it stupidly. Sure, it could be referred to that way, but anything can be referred to in a different way, right, or a different context. What we're talking about is the prudent use of the refi till you die strategy to strip equity out at long-term fixed-rate mortgages, and your rents are going up over the years, so they're covering more than the cost of that new financing, and that's tax-free because there's no tax on borrowed money. Check out my refi till you die strategy on the podcast and on the YouTube channel. It's been extremely popular and extremely valuable. Income property is one of those few assets where you can buy the property and you can renegotiate the deal all along the way throughout your ownership by refinancing it, changing the structure, changing the rent, improving the property. You get to constantly renegotiate the deal, right? And you can get all of your money back out of it and still own the asset. That's just phenomenal. With what we call self-liquidating debt. So very, very valuable strategy.
Yeah, so Robbie says, question, if you had $500,000 to invest and you were Canadian where house prices are astronomically high and the best hedge for inflation is real estate fixed plus precious metals, where do you invest? This is a different answer today than it would have been a month ago. Right now, as a Canadian, getting a property in the United States is much tougher just because of the lending practices. Now, actually, if you're a Canadian investor and you're not a U.S. citizen, it will be different. The lending for foreigners has become tighter, has become harder, has become more expensive. So you would just have to check and see if with the rates that they're able to give you, if the properties make sense today as a foreign investor.
Yeah, so foreign nationals do not get the benefit of the best financing, but it's still pretty good. And Ravi, most Canadian markets are very overpriced and they're very cyclical. So we are not fans of Canada. Remember, we could easily be recommending international properties anywhere. Okay, we're not attached to the United States for any particular reason other than the fact that the deals are very good. And the U.S. has a very special real estate market. I've traveled to 87 countries over the years. I've looked at real estate deals in many, many countries. Many developers and sellers of properties internationally are hitting us up on a regular basis, trying to get us to recommend their properties. And we just haven't found them to be that great. So we haven't done it. Right?
Yeah. So DVH says your labor costs on metal studs may make up for the offset on wood cost studs.
Well, that's up to the builders, and they keep going back and forth on that one. Adam, any comment?
I agree. I mean, that's if the steel was cheaper, I assume builders would use the steel.
Yep.
They're going to use what they can make the most money on and what's still safe. So many towns are banning Airbnbs. Santa Barbara. What can you do to fight back?
It is tough to fight back. That is a difficult proposition. And, this is one of the reasons we just like long-term rentals better. Santa Barbara, of course, is in the Socialist Republic of California. So it's really tough. And Santa Barbara is particularly socialist itself as a city or as a county even. But it's a beautiful area. So I would say rent a home there for yourself and buy lots of affordable housing through our network that you can rent to other people at much better rent to value ratios. Adam, by the way, I want to ask, we've been going a while here. Are you done with your presentation, your content?
No, I have a little bit left, not much.
Do you want to get to that or
Sure.
Keep doing questions and comments?
Sure, we can switch over to that real quick.
Let's
it's just about the forbearance news that came out that I think people need to know.
Okay. And remember, everybody, go to pandemicinvesting.com, get your free mini book there that will teach you about how to invest during a pandemic. That's at pandemicinvesting.com. It's totally free, and it'll get you connected with us so our investment counselors can reach out to you and help you. And Adam, I don't think your screen is in the stream. Let me put it back in. There it is. Okay.
All right. So steady exits push forbearance rate down to 5.05%. Mike Fratantoni, Mortgage Banker Association Senior Vice President and Chief Economist, said We expect that a stronger job market will help many successfully exit forbearance in the months ahead. Back in September, whenever we talked about forbearance, there were 3.4 million properties in forbearance. That has dropped to 2.5 million currently. So I just wanted, we're seeing a steady outflow of people from forbearance. And as the economy, really picks back up and becomes full, they're expecting the forbearance to, just become smaller and smaller. And so if you were waiting for that big flood of homes from forbearance, it's not looking very good for you in terms of waiting there. So that was, I believe, pretty much what I had there for forbearance. Yep.
Oh, that was it. Okay.
Yep. It was just a quick thing. We haven't talked about forbearance much lately, so I just wanted to give an update of how many people were in forbearance, and just showing that, a lot of people back mid last year were saying there's going to be a massive flood. We're going to have so many foreclosures, so many people getting kicked out, and my prediction came true. Yeah. They're bailing people out until they can stay in their homes.
Right. Yeah. Just folks, if you are sitting by waiting for the market crash, don't do that. You're going to miss out. Okay.
Have a comfortable chair.
It is. What do you say, Adam?
If you're sitting by waiting, have a comfortable chair, because you're going to be waiting.
Yeah. And all of these, I find that a lot of these people that keep saying, oh, you're wrong about this and that. Listen, first off, I want to say, I do not like this market. This market, and Adam, you're going to agree with me on this.
I agree.
My counselors will agree. This market for us sucks. Okay, it's very difficult to operate in these crazy markets. We like a more even keel. We like homeostasis. Okay, where a market is a little bit more balanced. It's very imbalanced now, and it's very hard to source good inventory. If we wanted to be sleazy operators and think short term, we'd be dumping a bunch of crappy inventory on our clients. But we're picky about it, right? Because we value the long-term view of the business, of course, and really want to make sure our clients are getting good quality properties. So we curtail our business for that reason. It's not as good as it would be otherwise. But you got to just make good judgment calls like that. And it is not our wish to have this crazy market that we have. We do not love this type of market by any means.
I mean, I would love to have clients be able to, get, look at 3, 4, 5 different properties, have time to really evaluate which one is best, and then make the offer and get the contract. But it's just not the way it's been for the last year and a half, 2 years.
Yeah. No, it is definitely not. Okay, let's finish up these comments and we'll wrap it up for today. Gosh, where were we? Okay, I think we're here.
Yep, and then the next one was Airbnb. We covered that one. Okay. Norman wants to know, just wondering if the indicators show what happens in the U.S., the rest of the world will follow or not.
What does that mean? I don't really know I don't understand the question.
I mean, if the rest of the world, if it's the rest of the world housing market, I mean, our market's just different than the rest of the world.
Yeah.
But I don't know if it's just overall economics or housing or what. I don't know.
Yeah, I don't quite understand the question. Norman, feel free to clarify that question and we'll try and answer it for you. Okay.
So LG says, I hope you are correct. I work in the stock market and this is not what I'm seeing across the board. There are problems brewing due to interest rates rising. If markets drop, wealth decreases.
Yeah, right. I agree. The economy is dysfunctional in so many ways. I mean, look at the repo market again and everything that's going on. There are tons of issues, okay? But these cheap mortgages, people are not going to want to let them go when interest rates rise. You've got to understand something, okay? The asset consists of 2 components. Yes, it's the house. That's what most people consider. But the mortgage is a huge part of the asset too. And if they sell that property, they lose the mortgage asset. So when rates rise, think of it like a bond. Look, you're in the Wall Street world, okay? And by the way, another measuring stick that I didn't mention earlier at the beginning of this live stream today is the S&P, for example, or the Dow. Right? Use that as a measuring stick too, to compare it to the price of these materials. What's one share of the S&P versus the cost of a home, right? And I've got a whole presentation I'll be doing on this that you'll see on the channel in the future, where we compare the price of real estate to a whole bunch of things, all right? But think of it like a bond, okay? LG, look, you understand bonds. You're in the Wall Street world, right? When interest rates go up, bonds become less valuable. When interest rates go down, they become more valuable. So that's this inverse relationship. The same is true about all of these millions of mortgages on houses that are so cheap. When they've got these locked in 30-year cheap mortgages and rates rise, all of those existing mortgages that are locked in become more valuable, causing people not to let go of those properties, creating an even more severe supply shortage. And we've already got a supply shortage. And we're easily 300,000 homes a year short in supply. And I don't see how that's going to change. Tell me how that's going to change. Less buying occurs. That's your next comment. I agree with you. Less buying occurs. So what? There's still a shortage. How do you fill the gap of the existing shortage when these people that have those cheap mortgages won't let go of their properties? They won't sell them. Adam, any comments or thoughts on that?
I'm with you on that.
I think the shortage continues for quite a while. Now, granted, it doesn't continue everywhere. Linear, cyclical, and hybrid markets, they're different, okay? We like the linear markets, and in the linear markets, this shortage is, and then combine that with my pandemic investing strategy, get that free book where I talk about the suburban tsunami and how people are moving to these suburban markets. And the shortage is even more severe.
So Think and Grow Rich says, my friends work for a home construction company in Austin. They stopped building custom homes because it takes 6 to 9 months and supply costs are going up. They now just build and they sell within 48 hours. I wouldn't build custom homes right now in Austin. It's not worth it.
That's pretty risky stuff.
Can you explain regression value more?
Yeah. So a long time ago, I coined the phrase regression to replacement cost. And, there's a lot on this on the Creating Wealth podcast, especially on the old episodes around 2011 or so. Those are all accessible at jasonhartman.com or on any podcast platform. And the regression to replacement cost concept is that for a time, properties were priced below the cost of actual construction. And what I used to say is that there's a distinction between price appreciation and regression to replacement cost. So when people are paying, when they buy a house, when they're paying for what a piece of wood costs, when they're paying the full price for the wood, the lumber, or the copper wire in the walls, or whatever else, the ingredients, the packaged commodities, that will cause prices to go up immediately, and it won't be considered appreciation and should not be called appreciation. It's just regression to the replacement cost.
Okay. I don't know what Steven's talking about there.
Okay.
Jorge says, "Long live Trump."
Yeah. And what does this mean?
Joe, I'm assuming that's, I don't know. I'm assuming it means because he moved.
Yeah, left California, maybe. Okay, yeah.
Sarah says, "Miss that guy." I'm assuming she's talking about Trump, not Joe Rogan.
Yeah. If it's Sarah, she's probably talking about Trump. Adam does not miss him one bit. Okay, so what?
Craig says there's a point. Craig says there's a 0.9 month supply in Twin Cities, Minnesota, not very landlord friendly though.
Yeah, very landlord unfriendly, but a constrained supply is pretty much everywhere, Craig. So yeah, absolutely understood.
Interactive. Yeah, we've been working on the interactive property search tool the last few days. We've had some issues, but they are working on it, and hopefully it will all be fixed.
Well, supposedly as of yesterday, everything was fixed. I hope that's true. Michael, you're in communication with us, so feel free to let us know directly if you notice any problems. You can email us. Okay, thank you for that.
Do you have a Discord community?
Discord community, and I don't really even understand what Discord is. Adam, do you know much about it?
I do not. I don't follow many social media platforms.
But I will tell you, we do have a private community called the Empowered Investor Inner Circle that you can join. There is a small cost to it, but well worth the investment. And it's focused on pretty much everything for real estate investors, but a large focus of it is on self-management and management in general, managing your managers more effectively and trading the dirt on the property managers and their dirty tricks. Okay. So check that out. Any of our investment counselors can help you with that. And Michael, thank you. We rock. We appreciate it. And we're here to provide value for you. So we appreciate you following us.
Benny Boo says, how to hedge against inflation and profit?
Buy income property. Short answer.
Most historically proven asset class?
It's the most historically proven asset class in the world and the most tax favored asset class in America.
That's for sure. Michael says Vegas market getting insane. Saw a party track home listed for 1.7 as a resale, sold for 1.5 million with a dirt backyard. Absolutely insane.
Wow. I wonder how many square feet that was. I'm really curious, Michael. Post the square footage if you
probably 1,300.
Oh no, Vegas isn't that expensive, but yeah.
But I mean, that goes back to, you were talking recently about, I think it was on one of the Creating Wealth podcasts, how, they were showing that homes were selling for over asking price on average now. So houses are selling for about 101% of asking price now, if you look at it nationwide. So yeah, it's absolutely incredible. R-Rated said, does Florida have the same situation as Texas with multiple offers and all cash buyers for investments? Also, won't flood insurance put a damper on cash flow for Florida? I heard it's expensive.
Well, flood insurance isn't required everywhere, and it's not necessary everywhere. Yes, we do have multiple offers and bidding wars in many cases. Texas has high property taxes. Florida has hurricanes. Okay, pick your poison. Every place has something. California has.
And I will say, when you come to our network, we don't do bidding wars.
Yeah.
Our providers offer the property, and whoever asks for the contract first gets the contract.
And we require, by the way, that they offer most favored nation pricing status as well. So keep that in mind. Okay.
Jessica wants to know where we recommend investing in Oklahoma. We're looking in and around the Oklahoma City area. One of the biggest things you can do to help yourself if you're evaluating markets there is look at what industry is fueling the area and make sure that it's not an industry that can easily pick up and leave. Make sure your population is at least holding steady, if not increasing. We prefer increasing, obviously. And then, just looking at the rents and the values and, whether or not it can cash flow. But even if it can cash flow, if it's cash flowing in a market where people are moving out and the industry could easily pick up and leave, I wouldn't look at that market.
Yep.
And Nemo says you guys have never seen your properties because your numbers are solid. Just repeating the process in a proven market, wash and repeat. Same here.
I mean, I don't want to say I haven't. I've seen some of my properties. Okay, it's not. I don't do everything remotely always.
I haven't.
I'll give you an example. I went to visit my mom, and she was taking me to the airport, and a couple of my properties were near this airport she was taking me to when I was flying back home. And it's like, I was thinking, okay, it's going to take about an extra half hour to go and see a couple of my properties. And I didn't bother. Like, so what? I mean, I don't care. I've owned these properties for 15 years and I don't need to see them. Like, what do I need to see there? Like, if I own stock in a company, do I need to go see the company? No, I just care.
It's also, what is driving by it going to do that Google Street View isn't going to do, really? I mean, unless you're going to knock on the door and go inside, which you're not.
And I don't care about going inside, and I don't care about meeting the tenant. So, good stuff.
So R-Rated said, what's your average cash on cash return you guys aim for when obtaining investment properties?
Let me answer that first, Adam. I'll let you after that. Less than it used to be.
Yeah.
Go ahead.
Yeah, I think for me, I have my numbers that I like. They've definitely been hit by the current home prices escalating. what I'm looking at now as I'm looking at future properties is not necessarily what it might get me this first year. I want to make sure that it will positively cash flow the first year, but I'm looking at year 2 and year 3 more than I'm looking at year 1. Because, you know, if you look at kind of how the rents have gone in the market, just look at your market and say, you know, over the past year, rents have gone up $50, $60, $75. What's my cash flow going to look like? And what's my cash on cash going to be next year if my rents go up $40? You know, how am I going to be happy with that? You know, and then if it continues along that line. So I'm not looking so much at year 1 right now as I'm looking at year 2 and 3.
Good stuff. Adam, you know what? We have got to wrap it up. And there are hundreds of you online, and I so appreciate all of you joining us. And wow, you really stuck with us. We've been on for an hour and a half. I got to jump to another appointment, and we still have more questions. Please reach out to us through pandemicinvesting.com or jasonhartman.com. Our investment counselors are available, no charge. Okay, you know, we're a referral network, and that's how we make our money. And they'll be happy to answer questions for you. Some of these questions are fantastic, by the way.
Yeah,
so
we don't want to lose them. Go to jasonhartman.com/ask and type in your question, and we will get to it either on another live stream or Jason will talk about it on the Creating Wealth podcast.
Yeah, good stuff. Good stuff. So we will have another Creating Wealth podcast out today. We do those every Monday, Wednesday, Friday, and then regular new videos on YouTube and the other censorship-free platforms as well. So check all that out. And we appreciate all of you. Thank you so much. And I want to wish everybody very happy investing. And Adam, thank you to you for your great content and helping MC the show. Really appreciate it. And happy investing, everybody. Bye-bye.
Bye.